Hey everyone, welcome back to the channel. This is going to be the last video in our due diligence series on Walmart. And in this video, I'm going to show you the DCF, walk you through it quickly, and then link it up and interpret what's coming out. So this is the DCF template I use. This is basically an exact copy from my days in investment banking. This was kind of the standard DCF you would see in a lot of different models coming from private equity firms, from, if you're helping a corporate. If you're doing any sort of valuation, this was the DCF we did. And ultimately what we were trying to get is unlevered free cash flow. So just walking you through it real quick, what it is you take revenue less COGS, and that's gonna get you your gross profit. You're gonna back out your SG&A costs, excluding depreciation and amortization, if that's available. So Walmart doesn't specify on their income statement. There probably is D&A in here, but it is only 10 million, so it's not, or 10 billion, nothing huge. Um, and then, right, so if you take gross profit less out SG&A, assuming that this excludes D&A, that's going to get you your EBITDA, so earnings before interest, tax, depreciation, and amortization. Then you're going to subtract out your D&A, and that's going to get you your EBIT. From there, you're going to calculate taxes, and that's going to give you adjusted EBIT. Now, really what we're trying to do is we're trying to understand how much free cash flow does this company have that can be used for debt servicing, for investing in operations, for paying to shareholders. So we're not looking at interest from that standpoint. Like, yes, they have interest expense probably. Yes, that is a cash expense, but we're excluding it because we want to know how much cash flow does this company actually produce that could be used to invest in things. So after we have our adjusted EBIT, we're going to add back our non-cash items. So we're going to add back depreciation. We're going to subtract out capital expenditures because Capex is something that is an investment in the business that's not flowing through the income statement anywhere on here. So this flows through statement of cash flows and it'll be on the balance sheet. And then we're going to look at our change in working capital. And I'll walk through what that is. It's current assets minus current liabilities. And really what it is it's kind of the investment or the cash needed to kind of run the business. So I'll walk you through here. If we look at current assets, right, so this is 72 billion. If we go over to our balance sheet, it's going to be our receivables, our inventory, and our prepaids. So we exclude the cash piece here, but really we're looking to understand, is it a use of cash or a source of cash? And if we think about it, receivables, this is something that has yet to be paid to us, but we are recording it as income or as revenue on our income statement. So this is $7 billion that we recorded as revenue that really hasn't been received yet. So it's actually a source or a use of cash, right? Like we're recording it as revenue even though we haven't received it, so we don't actually have the cash yet. So it's a use of cash from that standpoint. Inventories, similar thing. We've spent money on inventories. We obviously haven't sold those inventories yet, so we haven't collected revenue for them in cash for selling those pieces. So we've deployed cash into these inventories, but we haven't sold them yet. So it's basically just taking our cash and instead of being able to spend it on something else, it's stuck in inventories. And then prepaids, same thing. Think of a prepaid as paying a vendor in advance, something like that, right? If you have, say you have a new building that's happening or something and a bunch of contractors, building it out, you throw a bunch of money at it before it's done, right? So this is just a prepaid expense. It's something that you paid in advance of receiving it. So you've deployed your capital, your cash at it, and you no longer have that cash. Doesn't flow through the income statement anywhere. So we have to record that as well as part of our current assets and our working capital. Now we'll do the same thing for current liabilities. And what we'll pull here is we have accounts payable and accrued liabilities. And if we look at the other ones, none of these are things we're going to want to capture here because it's debt. And then income taxes, we capture income taxes separately. So accounts payable, right? This is the same idea. This is, you go to your vendor, you say, give me 10,000 widgets to sell. I'll pay you in 90 days, right? And someone like Walmart has this ability. There's such a big, such a big market force in this space, I would expect to see higher liabilities for current liabilities than current assets because they can basically say, we will pay you in 90 days, so extend their terms, but you will pay us in 30 days. So, right, their receivables should always be much, much lower than their payables just because they have so much power, negotiating power in their space, right? Getting your product in Walmart is huge. So as you can see, right, receivables is very low. They probably try to keep that to zero. They probably try to tell, all these people you have to pay us immediately to keep receivables as low as possible. And then payables, they're, hey, we'll pay you in 90 days. We're good for it. Deal with it. And these manufacturers just have to deal with it because they want to sell through Walmart. Um, and then accrued liabilities is another similar thing. This is you're basically accruing for something that you haven't actually laid the cash out yet. So some examples of this, if you're thinking internally to a corporation, could be like annual bonuses, right? You're accruing every month part of their annual bonus, even though you haven't paid it to them yet, because you're going to pay them at the end of the year. You'll pay them that one-time bonus. So things like that. Uh, or, it could also be, accounts payable is really going to be suppliers and vendors, more or less, for inventory. Accrued liabilities will be things internal to the company. But if you have you may accrue payroll on a 30-day basis, even though you only pay it twice a month. So just different things like that. So that'll also be encompassed within our current liabilities. So from there, you'll see we pulled both of those in, and we're going to calculate our working capital. And then from there, we're going to do a net working capital turnover. So if you look at the formula here, it's going to be your working capital divided into your revenues. So it's basically, how many turns of working capital a year do you go through based off your revenue? And 31 to 38, so negative, so meaning basically, right, they're always making cash, generating cash from their working capital. In that sense, like, right, they're saving, deploying their cash versus deploying their cash. That's probably not the best explanation, but they are, in a sense, I think it goes back to that relationship ability with their suppliers. They can say, you pay us in 30 days, we'll pay you in 90 days, kind of thing. So basically, they're always extending terms in their favorability as much as possible. So from them, it's productive to their cash flow perspective. So it's a negative working capital, basically just meaning it's a source of cash to the overall business of how they're able to kind of strong arm suppliers and use their weight. Now, to forecast out, you could do current assets as a percentage of revenue, you could do current liabilities as a percentage of revenue, or you could do a net working capital turnover and calculate it that way as well. To be honest, I don't like to have a DCF where a lot of it is driven by the working capital, right? If your company is only generating cash flow because it's really good at managing these relationships with its suppliers and stretching payment terms and things of that nature, like that's not a good business model. We need more than that. So what I like to do um, is kind of ignore the impact of working capital. The best way to do that is to set the net working capital turnover to the prior year, and you will see minimal variances flow through your unlevered free cash flow. And you'll see on the cash flow here, you'll see working capital negative 15, 17, negative 15. And if you look up here, you'll see 2, negative 2. So this is the change in working capital. So if working capital went from negative 15 to negative 17, that means it generated $2 billion of cash flow because it got more negative. And then in this instance, right, it got less negative, negative 15 to 17. They used $2 billion of cash that year in comparison. So it's a change aspect, and you look at that year over year change to if it's getting more or less positive. You can see when we set this right now, before we flow through any other assumptions, this just stays at zero. I think that is ideally what you want in a financial model. You don't want that line to be driving if you should make an investment or not in a company. So just something to think about. And you could look at it, there could be companies where this is a positive number and it's early on. And over time, you have it modeling to come closer to whatever the industry norm is, and closer to zero, and becoming a little bit of a source of cash that you could rely on in the future. And that would be fine, but you don't want it to be. Some companies have crazy swings here. I think like Tesla had, I don't remember, but I think Tesla generated like a couple $100 million of cash flow for them, which was huge at the time, just based off their working capital and their inventories and payables and things like that. And like that's not what you want. You don't want that to be a big driver of your valuation. So just something to keep in mind. Anyways, so I've linked in everything in green here is linking from another tab. So the revenue, this is coming from our revenue schedule that we did in part 4, forecasting out revenue. And then I layered back in the membership revenue. So I've just held the membership revenue flat. This is gonna be Sam's Club membership. It's actually been decreasing, which is a bad sign, but I just held it flat at about 4 billion. So link that in. Cost of goods, this is coming from the income statement. So we copy that over. That'll be this piece. SG&A, same thing, that's coming from the income statement. This operating stuff, right? And then we link in down here, or taxes, I guess we link in the taxes as well, coming from the income statement. And for taxes, we will calculate the effective tax rate. So you can see here we have tax rate 38, 51, 78. And something to note here, this is based off EBIT. That's how that's calculating, not based off net income. But going forward, I just hold the tax rate flat to the corporate tax rate, which is 21%. That's a pretty standard assumption that you would do in a lot of DCF models. There's a big difference between your cash taxes and your the taxes you see on your income statement don't reflect your cash taxes. There's a lot of like deferred tax assets, deferred tax liabilities, things of that nature. If you have losses that you carry forward, different accounting treatment in different areas, right? It can get really complex really quick. And some people I'll see like try to link it back to this stuff. This is meaningless. Just like pick a corporate tax rate, keep it constant in all your models, and you have like a apples to apples comparison. You're going to assume the company is doing whatever they can to minimize their taxes, but similar to working capital, this should not be like the driver of your model. So link in the taxes, and then you'll see D&A and capital expenditures. Those are linked in as well. We copied those over from the income statement tab down here. So you'll see all that. So now what we'll do is we'll go ahead and just kind of finish out our forecasts and how everything's kind of looking. So COGS is a percentage of sales. This has been pretty, pretty close to 75%. Doesn't look like it's ever changed. And I wouldn't expect it to. Walmart has low prices. They probably operate on kind of a cost plus basis. And I would guess 75% is probably where they're going to stay. So we have that aspect of it. SG&A, this actually, doesn't look like it's changed. So let's do the average here. And, I think SG&A is actually going to decrease just ever so slightly into the future. The reason I say that is just like as revenue grows, as the company becomes more and more mature, even though it is already a very, very mature company, revenue grows, SG&A is going to slightly decrease. It doesn't scale proportionally to revenue. So leaving it as a constant percentage of revenue is saying like you're always increasing your SG&A costs, simply just not the case. So we'll just have an ever so slightly improvement there. Now, Capex, this is a fun part. Capex as a percentage of revenue looks like it's been at 2%. So we'll do the average here and we'll leave it pretty steady. So a company like Walmart is actually pretty straightforward because they are such a big company. A lot of these things are already kind of set in stone. They're not going to change too much over time. Whereas if you look at like a high growth company, right, like something like Tesla, right, their COGS and their SG&A are going to be pretty crazy right now, but in the next 10 years, you'd expect those to reduce drastically as they continue to improve scale and manufacturing capabilities. So just something to keep in mind. A company like Walmart, it's pretty easy to actually kind of value some of this stuff. Another company, maybe not as easy. And then depreciation is a percentage of CapEx. I think that this will be close to 100%. Usually I say 80% in my videos, and that's because that's a good mix of growth CapEx and maintenance CapEx. Having basically depreciation being 80%, that means like 80% of your capital is kind of maintenance and 20% is growth. So you're always kind of adding a little bit more CapEx and you're depreciating. A company like Walmart, with their scale and their size and their footprint, they're not really growing that much anymore, and that's reflected in our, revenue growth of 2%. We have them kind of basically just coming to a standstill. So really, I would expect this to actually stay close to 100%. My guess is in 2021, this went up because they cut Capex funding or they wrote off some assets in the year just because it was COVID. They already knew it was going to be a high revenue year. So let's just book some more depreciation, let that flow through the income statement, and we'll still look pretty good from a total company perspective. So I think that this is going to go back. I'm just going to set this to 100%. I think those will be pretty neutral to each other in the future. I think they're just kind of in maintenance mode. So, we'll layer the stuff in. Now we got to add in net debt. If you're not familiar with net debt, that is going to be total debt less cash. So they have 27 billion of debt, and what we see here is we're using an 8% cost of capital. That gives us a $90 billion present value of the free cash flow. So that's taking all these free cash flows, taking the present value of them, gives you 90. Terminal growth rate, 1%. The reason I have this at 1%, you could tweak this a little bit, right? You could do 1.5. You could play around with it. But this is like how much Walmart's going to grow in the future. It's going to be less than 2%. It's not going to be zero. They're going to grow a little bit. Maybe they grow at inflation. I don't even know if they, I don't know if they grow at inflation. Who knows? They're a big company with a lot of revenue. Terminal value is this $300 billion terminal value. To calculate that, you take last year's free cash flow, multiply it by 1 plus your growth rate, this terminal growth rate, and then you're going to divide that by the difference of your WACC and your terminal growth rate. And then you're going to present value that. So after you get that, then we're going to calculate that 294 at today's terms based off your weighted average cost of capital. And that's going to get us 136 billion. So that gives us an enterprise value. So you're going to take the terminal value plus the free cash flow, gives us an enterprise value of 226 billion. So that's the total value of the entire company based off this model to buy it. And then we're going to look at their net debt. So they have $27 billion of debt. So that tells us the equity value. So enterprise value is equity value plus net debt. So if we have enterprise and we have net debt, right, we can get into equity value by just backing out the net debt because it's an equity value of 199 billion based off our assumptions here. And, let's see here, if we did 1, 1.5, 2, this is a sensitivity table showing us the different valuations just based off if you change your required cost of capital and your growth rate. So something to look at now. I don't even know I forget what Walmart's trading at. Let's go over to yahoo.com/finance. I think they're like a $300 billion market cap, if I remember correctly. 400. So they're trading at a $400 billion market cap. And with our pretty conservative revenue guesstimates, right, we're getting $200 billion market cap. And depending on how risky you think it is, and honestly, Walmart's not risky. So an 8% WACC might actually be kind of high. They might be more of a 6% WACC, right? And if you were to change this to 6, 5, 7, something in that nature, right, you get between a $230 to a $471 billion market cap. What that tells me, and WACC, for any new investors, I have a video on my channel about WACC. Definitely check it out. You could calculate WACC. There's a lot of problems with calculating it. Really, what I recommend people doing is picking the discount rate you require as an investor. And that's always a little tough to do because it's supposed to represent the risk in the company, but from an investor standpoint, it's what return you would get. So if you're comfortable with a 5% return and you believe all of our assumptions and you think the perpetuity growth rate is 1.5%, which is probably fair, right? $413 billion market cap is what you would get. And what that means is if our model is right and they match our cash flows, this stock should grow roughly 5% a year. You'd get a 5% return per year from stock appreciation over the next decade. So right? That's really what this is saying. So if you're like, well, I'm an investor and I need 10%, right? And you were to come in here and say, I need a 10% return, otherwise, this isn't a good enough investment for me. Well, at 10%, you would need to be able to buy Walmart stock at $141 billion market cap. And if we look at Walmart, if we look at the last year, right, last 5 years, I mean, they haven't been, market cap would be in half back in 2017. So it would have been a $200 billion company, right? They've never been that low. You're never probably going to get um, that low of a valuation. So there's kind of two things at play here, right? You can change what you require as an investor, which is your WACC, or you can change your assumptions. So we did revenue assumptions at kind of this really granular level, a little bit tough. How accurate is it really? Historically, they've grown 3%, 2%, 7%. Do we think they're going to bounce back up and be a 3% growth company forever? Well, what we can do is we can actually quickly just kind of pivot here and we can flow that through and we can see what we're going to get. So just completely throwing out the model we did for the revenue, say we think 3% is the correct piece, right? That's, growing at inflation for the rest of time. Let's see how their valuation changes now. And if we do 3% revenue growth, right, everything else is going to flow through because we have it all linked up. At 3% growth, do we really get that much different of a valuation? No, but I mean, I guess we could also set this to 3. So if we did 3, 2.5, 2, right? Well, if you only require an 8%, still overvalued, but if you required 7%, okay, 352, you're getting close. So, you can kind of try to back in almost to what the market is expecting. If you're assuming people on average are requiring roughly the return of the S&P 500, which I think it's like 11%, and then inflation adjusted, it's like 7 to 8%, something like that. So if you require an 8% and you're like, how are people getting a $400 billion valuation? This is something I like to do too, is see kind of what I think the market is saying. Is the market really expecting, they could be expecting more than 5% growth a year. Are they expecting 6, 7, right? So if we do a 7% return or continued growth for the next decade, with everything else basically being constant, and we assume a 3% perpetuity growth, so let's set this to 3, 3.5, 2.5, right? Okay. At an 8% return for a company the size of Walmart, which is a pretty safe company, right? Sure, you can get the current market valuation. Now, is that realistic? Is it not? I don't see the growth story for them to continue pandemic level growth, unless if they make a huge push into e-commerce, completely disrupt it somehow, taking market share from Amazon, which has 2-day shipping, the best prices on anything, super intuitive, easy to use. And I don't know if you've been to Walmart.com. I hate their website. Like let me just type in like Xbox Series X. You'll see it says they have it for $385. But if you look at it, like what's Xbox Series? So the MSRP on this is $300. It's being sold here for $385. So basically it's on Walmart's website for $86 more. And basically what's happening is like when I went to Walmart, I was expecting things to be sold by Walmart. So I know this is kind of like just a, complete random tangent, but this is why I don't think their e-commerce is going to be that great. Is like you can come in here and you can, I don't know where it is, retailer, right? You can come here and look at their retailers, and similar to Amazon, they let anyone sell, but it's just for me it's confusing because when I think I'm buying from Walmart, I think I'm buying from Walmart. When I'm buying from Amazon, I understand I'm buying from a multitude of sellers and the price can be different. I would expect Walmart as a retailer to have one consistent price, and that's just not the case, right? You'd have to come in here and select Walmart.com, and then you'll see they don't even have that Xbox for sale, and it's through these third-party sellers where they have it, and the price is inflated. Um, so from that standpoint, I think Walmart has a lot to do on the e-commerce front. So I don't think that that's going to be the catalyst for growth. And these are just things that I think about as I use the websites, as I go through and build out these models. 7% growth. They experienced 7% growth when the world was shut down. Everyone was at home, and you couldn't even buy toilet paper because people were hoarding it. So like their sales for cleaning supplies, groceries, everything skyrocketed in the last year, and they got 7%. To think that they can maintain that for the next decade and do $1 trillion in sales, I'm not buying it. Um, so for me, I would personally anchor on there's kind of two things at play here. It's either people are expecting this and they think they're going to get a good return, or people are comfortable with this being a 3% growth company forever and requiring, call it a 6% whack. People are looking at this as like, this is just a safe play, right? This is a safe play. You're going to get a 6 to 7% return, right? It's not going to be a volatile stock. It's it's a good stock for your portfolio to round it out. Um, that's how I would think people are looking at it. Um, I don't know if I calculate dividend yield. Do they pay dividends? Yeah, you're getting a 1.5% dividend return. So people could be looking at it as like, you know, I think I'm going to get 6%, 7% return on the stock, right, over the next decade. That'd be fairly valued if you think they can grow in perpetuity at 3%, and then you're getting 1.5% return on a dividend annually. So you're looking at an 8.5% return. You're pretty comfortable with it. You don't think there's a lot of risk in it. Could be a good buy at that if that's kind of the approach you're taking. Um, so is it undervalued? Absolutely not. I don't think Walmart is an undervalued company. Is it fairly valued? I think depending on how you look at it. Um, if you're looking at it as this slow and steady stock with not a lot of stock appreciation, just kind of chugging along slightly below the S&P 500, and then you layer on a dividend, you'll probably keep pace with S&P 500 without much risk, right? I think that's kind of the story of Walmart. I don't think anyone's actually thinking they're going to grow 7% and give you a 9% return plus a dividend. But who knows if they successfully transition into e-commerce, that could happen. Um, but yeah, this is really the process, and this is, I guess, just to wrap up this series. This is the step one of my due diligence process. And what I mean by step one is I go through all these steps and I get an understanding of the company. And when I look at something like this, when I see Walmart and I see this, I'm like, okay, I can rationalize it in my mind what I think the market thinks of the stock and how it's trading and why it's trading that way. And from there, I would probably say, if Walmart drops to $250 billion, right? I could make an argument for them to be undervalued, if their market cap could get cut in half. That's probably not going to happen, um, right? And if we look during the last 5 years, like that definitely hasn't happened at all, um, right? I mean, during the pandemic, right, it dropped down to 107. Could have been a good buy at that point, but who would have known with the pandemic? But the idea is I try to get an idea of what I think the market is thinking of the stock, and then it's not you're going to find that stock on day one. You're not going to do the valuation and be like, this is a buy, I need to buy it immediately. If this model came back and I got $100 billion valuation with these assumptions, I'd be like, okay, wow, that's, they're, if I got a 500 billion, sorry, and they were trading at 100 billion, I'd be like, wow, that's a buy. But I would also say like, what's wrong with my model and what's really going on? And that's where you need to go perform more analysis, really dig into the business units, look at the competitors and see, is there a reason why it's trading that low, or is it really an anomaly and actually a good opportunity? I think the problem a lot of retail investors have is they want to do an analysis and they want to confirm what they're going in thinking, which is like, I like this company, I want to buy it. And, there's a lot of great companies, but they're not valued great. Um, so you have to be patient, you have to wait, and you have to remember that, not every company you love is going to be a great company to buy the stock in. It could be trading at a higher price than what it really should. And you have to be patient. And, I always go back to, I think Warren Buffett said, like, pretend you have a punch card with 12 punches on it You get to buy 12 stocks in your life, right? Like you need to have a lot of conviction in that stock before you buy it. And when you buy it, you're going to go all in on it. He is not a proponent of diversification, clearly, holding 12 assets. But if you pick 12 great assets and they all grow, well, right? That's how, I think Buffett and Berkshire has done so well, is that lack of diversification. But it's also they're not making random gambles. They're not, just doing a quick analysis and buying a company. They're really finding companies and valuing them and saying, I think Walmart is worth $400 billion. And if they see, they can get a 7, 8% return a year based off their model, and the stock is undervalued by 30%, maybe that's a good buy, and it's probably a pretty safe buy. But you have to do a lot of analysis, and this is really kind of the first part to help identify what could be good investments, and then you have to understand how confident are you in your model, and then wait for the stock to be at an appropriate value to enter. And if it's not, it just is what it is. But um, I think we see too often in the market today where people want to just buy stocks and they want to gamble. And recently, if you've been buying the hot IPOs, the hot stocks showing up on the internet, you've done really well. Um, will that continue for the next 20 years? I don't know. I don't believe it will. I think someday GameStop and AMC and all these companies will, go back down. But who knows? Maybe some of them will do great. But I mean, even if we look at GameStop, right, it's just like all over the place. And right, if you bought at a lot of the points here, you made a lot of money. But that I don't think that that's investing. I think that's more gambling. Um, and anyways, long way to say, I guess I hope you found this useful, informative. I would encourage you to try to build out models like this for a handful of companies and identify companies that you think are undervalued, and then do further research to understand the competitors, go back to your comparable company stuff and look at how these other companies are doing, see how they've been growing, and see are your expectations correct, and maybe you actually did find a great company that's undervalued that you could get into. If you throw this together for Alibaba, I think I did, you get that Alibaba is definitely undervalued. But when you dig further into it, the reason for it is because it's a Chinese-based company through a VIE structure, and there's a lot of risk there. And a lot of people actually downplayed that risk. And I think just a couple of weeks ago, there was some Chinese company did an IPO, basically raised a bunch of money from U.S. investors, and then China was like, you can't have U.S. investors anymore, and basically these U.S. investors got fleeced for their money. So there really is risk in that aspect, but how do you quantify and value that? That's the $1 million question that no one can do. And if you don't think that that risk is as real, or you understand it very well and you're very confident in it, then Alibaba is probably a buy today. But you have to be comfortable and understand those risks. And in today's society, it's hard to find a company that's just undervalued. Those don't exist as often. During the pandemic, there was a ton of them. Everything crashed, 50% for a couple of weeks there. If you had all your entry points and your analysis and you understood that, like, yeah, this company's crashing right now, but X, Y, and Z isn't actually gonna stay down. Like, what did Google drop to, right? If you had analysis and you knew Google was a great company, um, and you saw it crash, and I guess I got to go 5 year, right? Like, you saw Google drop to 1100 from share price of 1400, and you knew Google isn't actually gonna, right? I mean, it took a 30% wipe almost, or probably 20% wipe in valuation. And you knew Google was a great stock and you had a price point entry, right? You could have made a killing. But you got to do that work ahead of time, and you can't just buy, I think you have to wait for the right entry point and identify the right companies, and then slowly enter your positions, and confirm them, right? If you had $1 million to invest, you don't throw it in on day one. Take your time, slowly, put a little bit in, make sure your thesis is correct, watch it for a year, put some more in. So I think there's a lot more to investing, even than just pulling together a DCF and getting a value. There's a lot of patience and waiting for the right opportunities. But anyways, I hope you found this series useful. Leave any questions or comments below. I've been pretty busy lately. I'm trying to focus a little bit more on the YouTube channel, put out some more content. So look for some future videos soon. Thanks for tuning in.